Hey everyone, happy Thursday, September 18th. It's a little after 9 a.m. on the West Coast, and it's time for another market update. Well, over the last couple of weeks, we've had a good run. Rates have come down quite a bit, and yesterday was the Fed, the end of their most recent meeting where they would be announcing a rate cut as we expected. They did so. They announced a rate cut of a quarter of a point. For someone that's not paying very close attention to this stuff, that sounds like it'd be great for mortgage rates. The Fed cut by a quarter point. A lot of people reach out to me and say, hey, does that mean, mortgage rates went by a quarter point? As we talked about before, that's not the case. Mortgage rates are not directly connected to the Fed rate. The Fed rate controls overnight banking rates. So it's more closely tied to home equity lines of credit, credit cards, adjustable rate stuff. In that regard, the Fed did lower the rate. However, like I said, mortgage rates are not directly connected to that. So actually, mortgage rates ended up going up yesterday. And part of that reason is that, as soon as the Fed met August 22nd out at Jackson Hole, Wyoming, when Chairman Powell spoke, he made it clear that they were going to cut at that point. The mortgage rates are driven by, mortgage-backed securities, treasury yields, things like that, the economy, and the markets. And the markets do not wait. Once they knew that the Fed was going to cut, they started building in that cut. So since that point, since August 22nd, mortgage rates have dropped about 3/8 of a point on the average conventional, up to about a half a point, depending on where you look. So we already got the benefit of the quarter point. However, the main point, what we talked about before, is what happens after the Fed announces their cuts. They do a statement release. They sometimes, like they did yesterday, release their projections, and they also do a press conference. So oftentimes, once we get to the day of the cut, once everybody already knows they're going to cut, we don't care about that anymore. We care what they think, what we think is going to happen afterwards, with the next couple meetings this year and going into 2026. And that's where things got a little different. So let's firstly take a look at their statement. So the Fed came out and said they're cutting a quarter point. That brought the Fed fund rate down to about 4.25. They, in their statement, they said that policy is clearly restrictive, which means they say rates are basically too high, which is a good thing. We like that. They said the growth of economic activity moderated in the first half of the year. So they're basically saying our economy slowed down, which is true. They said that, previously the focus was on inflation, but now they think there's a downside risk to labor. Labor's slowing down. Keep in mind, the Fed has their dual mandate. They got to keep inflation low and jobs high, basically job growth high. And so they're basically trying to get that more balanced. So they're watching both. But there's a risk to both, is what they're saying. Job gains have slowed. Unemployment rate has edged up, but remains low. Again, that depends on how you look at it. It's definitely up from its low points. Still at a low point historically, but we're definitely climbing. And again, that good that they recognize that the labor market isn't as strong as it has been. And then inflation has moved up and remains somewhat elevated. They think a lot of that has to do with tariffs, about 0.3 to 0.4 impact, and they think that's short-lived. Services inflation is cooling. Obviously, the lower inflation goes, the better for us. The higher it stays, the less chance they'll cut. So that's why we want, we want a little job weakness and we want inflation to come down. That's our best chance to get the Fed to keep cutting. And they will continue reducing their balance sheet. And there was no mention of reinvesting in mortgage-backed securities. So that would have been a good thing. If they had said, oh, we're going to buy a bunch of MBS, that would have been good for rates. But they did not say anything along those lines. So that was the statement. The next thing we got was their SEP, their Summary of Economic Projections. So this is where every member basically says what they think is going to happen as far as cuts going forward, what they think is going to happen with inflation, jobs, and so forth. So they think the unemployment rate will peak at about 4.5 by the end of the year, which is higher than it is now. So that'll probably be good for rates. They think core PCE inflation will remain about 3.1. It's showing at 2.9 right now. So, again, anything with inflation going up isn't necessarily good for rates. GDP, they had, previously they thought about 1.4% growth. Now they got a 1.6, which is higher, but still pretty low. It's pretty flat as far as economic growth. So again, not the worst one there for us. And the Fed fund rate, basically the median projection between all these members is they have two more meetings this year, one in October, one in December, and they think there'll be two more cuts based on the median. So basically they release this dot plot graph and we get to see not each guy's name, but we get to see, just on a plot, how many cuts they want to do. So we have two more meetings. We had one of these members wants a hike. They don't want to cut anymore the rest of the year. They want to hike it once. That could be Lisa Cook, who is under fire. That could be Schmid. Regardless, one of these members is not who we like. They want to raise rates going forward. 6 of these people want no more cuts. They think we're good now. Don't cut. in October, don't cut in December. And again, not what we want. Next, we got two of these members just want one more cut. So maybe that would be a cut in October, maybe one in December. But regardless, just two people want one quarter of a point cut. And then 9 people, however, want 2 cuts or a 1/2 point cut. So if half points cut from where the rates are now, so 9 total people want that. So that's more of what we want. And then one person, which we're thinking of Stephen Mirren, who was just appointed by President Trump. He came in at, or he or she or somebody came in saying they want, 125 bips. So basically 1.25% cut in between now and the end of the year. That's very aggressive. That would be awesome. That's why we think this is Mirren, since he's the new, more dovish tone on there, basically appointed to get them to lower rates. But that's a little aggressive. 175, even 75 would be great. But the way you see this break down, it's really kind of split. We got 9 people that want 25 bips or less, and we got 10 people that want 50 or more. So very split Fed. Generally, it's not like this. So we're gonna have to see where the data takes it from there. And then the next thing that happened is after that, Chairman Powell gives a press conference. He basically said there's no risk-free path. He was very kind of hawkish. He didn't say what we wanted. Usually we want him to say nice things. We want him to say, oh yeah, we're going to keep cutting rates. He did not say that and made it look like, they're on the fence, whether or not they're going to cut rates the rest of the year. It's not, set in stone. So that's what we didn't want to hear. And the market sold off of that. Going into that moment, I think, rates were about 6.13 average conventional starting the day. And after the press conference, it was at 6.22. So again, Fed cut their rate. Mortgage rates went up. That's not unusual. That happened last time too. So they're not connected. The mortgage rates had already come down. It's just that we didn't like what they said about the future, and that's why mortgage rates went up after they actually cut rates. So we're gonna have to see how inflation, jobs, everything goes forward, and hope that that comes in our favor and they keep cutting rates as we move forward. Next thing. So this would normally be a big one, but we got the August CPI. It came in basically as expected. Headline was a little hot. Supposed to be 0.3, came in at 0.4. Core came in at 0.3 as expected. That brought headline to 2.9 and the core year over year to 3.1. But if you think about core 0.3, you exploit that out to a year, that's 3.6. We don't like that. We want it to get lower. But it seems like if you dig in, as I say here, if you dig it in the numbers a little closer, it's OER that really created the core to go up. OER is owner's equivalent rent, where they basically ask homeowners how much they would rent their house for without, not furnitures, no utilities, on a month-to-month basis. Homeowners are not the best. It shouldn't weigh very much in this report. That should have nothing to do with anything. We shouldn't trust homeowners to figure that out. People like us that, people in the industry that pay very close attention to this would have a very hard time trying to figure out a month-to-month change on how much I could charge in rent for a house in Bend, Oregon, or Bay Area, wherever it may be. So that's something, kind of propped it up, but we're gonna have to keep an eye with, the different tariff stuff. Next thing we got retail sales. That came in above expectations. It was 0.6% headline, where it's supposed to be about 0.3. A lot of people think that had a back to school, people doing back to school shopping. But again, got to keep close attention to that. The more we're spending, the higher inflation gets. Don't want too much spending. This goes into our GDP. The more retail sales there are, the higher GDP will be. And people, that will be something the Fed will look at. Next thing, so 2 weeks, because I wasn't here for Thursday last week. Initial job claim last week was at 267,000, so a big jump. That was positive for us. We got a bounce off that. We got a nice little rally. Today, actually, came at 231, and so it dropped back down again. Estimate was 240, and off of that, we actually got some weakness. We had mortgage bonds retreat a little bit because it wasn't about the we already got past the Fed report, and now it's back to looking at the data. We want to see job weakness. We want to see inflation come down because we want to make sure that the Fed's going to keep cutting. So where does that leave us? It actually hasn't updated today. Like I said, it was 6.22 at the end of yesterday. It jumped after that press conference from 6.13. It's probably going to be in the 6.25 to 6.3 range today. And again, that is because of this initial jobless claims. It's because how, Fed Chair Powell talked last week, or 6.29. So, really not much gain after the Fed did their cut. But again, we got all that cut. Remember, we were at 6.75, 6.6, somewhere in that range. Now we're at 6.25. So we already got our gain. So don't, there's no correlation between the Fed cut of the rate and a direct cut to mortgage rates. Something important to keep in mind. Important dates. So we got PCE next week, inflation. Then the week after that, we get a jobs report. 2 weeks after that, we get CPI, inflation. And like I said, the end of October, my anniversary actually with my wife, is the Fed's next meeting. we're going to hope they cut rates at least a quarter point. We're going to have to make sure the data comes in our favor, though. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, just keep in mind, Fed rate does not equal mortgage rates. Mortgage rates already had started coming down, and let's hope they keep coming down. Have a great week, everybody. Thanks a lot.